This video, we're going to look at Micron technology and their computer manufacturer of storage devices such as USB flash drives and other products. In my videos, I run an Excel model to figure out the value of a stock and also look at the financial ratios of the company and compare them to others in their industry. So let's get started with the model. So they have a market cap of $55.4 billion. That's the value of the company according to the stock market. And their stock price is $49.83. And next we need the free cash flows. And free cash flows is the cash that's remaining after paying your expenses. So the way you value a company or any asset, you have to estimate the future free cash flows that company or asset produces and then discount those numbers back to today's value. And that's what I'm doing in this video today. Right now I'm pulling the net income from the income statement, and this is the company's profit and loss. We also need the revenue, which is the annual sales for the company. And I'll put that into the model. And look at this, their sales doubled from 2016 to 2019. Let's look at the capital structure of the company so we can figure out what discount rate to apply to the future cash flows. They pay $128 million of interest on its debt. And let's see how much debt they have. We'll go to the balance sheet for that. We'll go to the liability section. And under current liabilities, current debt of $1 billion. So that's debt due within 12 months. And under the non-current liabilities, the long-term debt of $4.2 billion. That's debt due after 12 months. And they pay 2.4% interest on their debt. Interest payments are tax deductible. So let's get their effective tax rate. We'll go back to the income statement. The income before tax is $7 billion. And the income tax is $693 million. So the cost of debt is 2.2%. To figure out the cost of equity, we need the beta. That's the volatility of the stock. The beta is not here, so I'm going to give them a beta of 1.5. That looks about where they're at. We need some more information from the balance sheet in order to look at the ratios. First, we got to go to the asset section and get their current assets. That's $16.5 billion. And let's get their current liabilities. That's $6.4 billion. And we also need their equity. That's assets minus liabilities. That's $36 billion. We need their EBIT, which is their operating income on their income statement. That's $7.4 billion. That's how much money the company makes through its operational business. So to figure out the weighted average cost of capital, it's a blend of the cost of debt and cost of equity. The cost of debt is 2.19%, and they have 13% of debt in the capital structure. And the cost of equity is 13.84%. And we figure that out using the capital asset pricing model. And they have 87% debt in that capital structure. So the weighted average cost of capital is 12.35%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's values. And we get a value for the entire company of $94 billion. We divide that by 1.1 billion shares, and we get an intrinsic stock price of $84. They're trading at $50. So they're trading at a 41% discount. It's a buy according to the model. Let's see what Simply Wall Street calculates. They're much higher. They're saying the stock is worth $174. Simply Wall Street is also saying the stock is a buy, but it's even more undervalued than my calculation. Let's see what the historical stock price shows us. It looks like the stock has been trading not much higher than maybe $60 at its peak. It's been pretty steady for a couple of years now. So the market doesn't feel the price of the stock is worth $80 or even $100-something. They're more comfortable paying $50. So it's really the sentiment of the market. That's what drives the stock price, not so much the fundamentals. Let's look at the financial ratios to get more information. They have a great PE of 8.8. That's price of stock over earnings per share. Under 15 is a really good PE. Price of sales is good as well. That's 2.4. They have a good price to book at 1.5. That's price of stock over book value per share. Current ratio is fine, 2.6, so they can cover their current liabilities 2.5 times. They have a decent ROE of 18%. They could easily cover their interest payments. That's not a problem. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Intel, NVIDIA, and Texas Instruments, and all these companies are in the semiconductor industry. If MU's ratio is green, that means it's better than the average, and if it's in red, it's worse than the average. And anything in orange means that company is the best in its category. So Micron has the best PE of all four companies. They're 8.8. The average is 31.5. They have the best price to sales, the best price to book. NVIDIA has the highest current ratio, but I actually think Micron has the best because NVIDIA doesn't need that much current assets to cover its current liabilities. Micron is the smallest of the four, but it's still a pretty big company in terms of market cap. So let me know what you thought of the video. Thanks for watching.